Want to see my Mr. Beast interpretation? In this video, we're going to talk about the IRR. Scratch it. I don't want to do that. In this video, we are going to talk about the IRR, the internal rate of return, what it looks like in a real estate syndication deal. Why is this important? Well, it's important if you're considering investing in a real estate syndication and you want to figure out if it's worthwhile investment. If you're new here, I'm not Mr. Beast. I'm Dr. Jeff Anzalone. A periodontist wanting to get you out of the rat race with passive income. Do me a favor, download the guide below the video. Now, what is the internal rate of return? What is IRR? What is that? First, let's talk about that. It's nothing more than a financial metric that investors use to measure the profitability of an investment that they're looking at. So basically, it's the annual growth rate that makes the net present value of all the cash flows, both positive and negative, equal to zero. It takes into account when and how much money you earn from the property, including income like rent, expenses, and any loans that are related to the property. In simpler terms, it tells you how much money you're making each year on average from your investment, considering the time value of money. That's it. So the next question that we should ask is, what's a good IRR? Well, it varies, and it varies on two different factors. And I'm going to give those to you right now. The first one is risk. And the second one is, well, I'm going to wait on the second one to keep you interested in my video. So let's say that you're a limited partner. You're a passive investor in a real estate syndication alongside me. We pool our money together with a syndicator, with a sponsor, to buy a large piece of property. Now, first thing is we have to look at the risk. So if your syndication that you're going to invest in, or that you're maybe looking at, if it's considered a high risk project, like maybe they're going in and they're renovating like this dilapidated, worn down apartment building in some high crime zone with the hope of bringing people back and leasing the units at premium prices, guess what? The anticipated IRR should be what? It should be high, right? This is because of the uncertainty and potential issues associated with this type of project. You may encounter unexpected costs, difficulty actually getting tenants to come in, or some major regulatory hurdles. As a result, a high-risk investment should yield what? A higher return, potentially 20 or more %. So basically, they're compensating you and me for taking on such risk. On the other hand, let's say that you partner with me and you want to buy an already successful RV park or already successful mobile home park that are fully occupied almost year-round, then that's much less riskier than the first one. And you can be pretty sure that it's going to continue bringing in rent money year round. So you would probably in that situation be okay with a lower IRR, say around 12 to 13%, which is still considered a good investment. Which leads us to factor number two. Glad you stuck around. We have risk, and then we have something called timing. The length of your investment also impacts the IRR. Now, if your sponsor leading the syndication plans to sell the property quickly, let's say 2 to 5 years, then you typically want a higher IRR. That's because you're getting your money back sooner, usually gives a higher IRR. Plus, investors often preferred not having to constantly go and reinvest their money and deal with all the hassle and cost of buying and selling properties. On the flip side, if the group plans to hold on to the property for a longer period, you could accept a lower IRR because you're taking into consideration the stable long-term returns and the avoidance of all the transaction costs associated with frequent buying and selling. To better understand these concepts and how they impact your investment decisions, I encourage you to continue watching these types of videos, or you can go to my website at debtfreedoctor.com. Remember, with investing in real estate syndications, knowledge is power. By understanding these key terms and principles, you're going to be better prepared to assess potential investments. Try to figure out is a deal good or not. And you can make more informed decisions that basically they're going to align with whatever financial goals that you have. So to sum it up, a good IRR depends on the risk of the property and how long you plan to hold on to it. Riskier short-term investments should have a higher IRR, while safer longer-term investments can typically have a lower IRR. Knowing this can help you decide if a real estate deal is right for you. Now, if you want to learn the real reason why rich people invest in real estate in the first place, check out this video.